Good morning, students. Welcome back to the session in Indias. So today we'll continue with our discussion on business combinations. In the last session, we started with common control transactions. In respect of common control, we understood the principle. What was common control? Wherein one entity is acquired by another entity, but before the acquisition and after the acquisition, the ultimate controlling party of the acquiry remains same. Yeah. So if the ultimate controlling party of the acquiry remains same, that would mean common control business combination or a common control transaction for which accounting requirements are different. As we discussed that all through whatever we have discussed in terms of the accounting requirements of business combinations were all in relation to other than common control business combination. The second requirement of common control transaction should be that this aspect that we check that before acquisition and after acquisition, the control which is remaining same, this should not be transitory. Correct? Yeah. If both the understandings are there, then we'll say it's a common control business combination. Now, under IFRS, I'm saying IFRS, there's no guidance available in respect of common control transactions. So that's why under IFRS, we generally see that common control transactions are also accounted for at fair value. Yeah. Why I'm saying fair value? Because all of these business combination accounting requirements that we have discussed have been at fair value only. But under Ind AS, the guidance in relation to common control transactions has been specifically included, and which is not really at fair value, which is at other than fair value. So that's why we can also say that this is also the difference between the accounting requirements under IFRS and Ind AS. Yeah. So that's why you will see these two things taking place now. Yeah. So let's quickly get on to the requirements of common control business combination. And then we'll start discussing certain examples on this. So if we look at common control transactions, we may have a situation when the ultimate controlling party is A, and below A, let's suppose E, which was controlled by B and ultimately controlled by A. So that means E shifts from B to D. Now E is not controlled by B. E, let's suppose, is controlled by D. So in this situation, what do we see? That even though the holding company of B changes, but the ultimate holding company of E remains same. So that's why such type of transaction will be called as common control transaction. Okay, clear on this? Yeah. Now let's get on to the accounting requirements of common control transaction. Under common control transactions, assets and liabilities of the combining entities are reflected at their carrying amount only. Yeah. So these are not accounted for at fair value, at carrying amount. Carrying amount means book value. However, when the acquiree gets acquired by the acquirer, and if the acquiree was following any accounting policy different from acquirer, in such a case, alignment of accounting policy of acquiree with the accounting policy of acquirer becomes important, and those adjustments will have to be made. Otherwise, all the assets, all the liabilities of the acquiree will move at carrying value. Number one. This is also something which you would have seen under AS 14 under pooling of interest method. Yes or no? Do you remember pooling of interest method? So that is the method which gets applied in case of common control transactions. Okay. Another very, very important point under common control transactions is about goodwill. Under common control transactions, we cannot have goodwill. We cannot have goodwill. Yeah, goodwill is never recognized in case of common control transactions. Okay. Next, financial information in respect of prior periods should be restated. What is a prior period? Comparative period. So if let's suppose we are talking about current year 2021, then the financial information of comparative year, that means 1920, this needs to be restated. And what is the criteria for its restatement? This should be restated as if business combination had occurred from the beginning of preceding period. That means business combination had occurred from the beginning, from 1st April 19. Okay. Yeah. However, if the business combination had occurred after that date, prior period information should be restated only from that date. Yeah. So around this aspect of a restatement, we'll discuss for the example. Yeah. Okay. Next. Now, when it comes to business combination and when it comes to acquiring any entity, once again, some sort of consideration would have been paid. So let's see what can be the consideration. Consideration for business combination may consist of securities like equity shares, cash, or any other asset. These securities or this purchase consideration under business combination other than common control, we discussed will be considered at fair value. Why? Because the purchase consideration is considered at fair value. But over here, these shall be recorded at nominal value. Yeah. And in determining the value of consideration, assets other than cash shall be recorded at their fair value. So if there is any other asset, that shall be recorded at fair value. Next, in case of business combination, when we were doing PP exercise, we do not move any reserve from the acquiree to the acquirer. Why? Because those reserves get included in the form of goodwill or capital reserve. But in case of pooling of interest method or in case of common control transactions, reserves shall be moved from the acquiree to the acquirer. And they will be maintaining the same form. Means in whichever form that reserve was appearing in the financial statements of acquiree, it will move to the financial statements of acquirer. So let's suppose if this was free reserve, it will move as free reserve. If it was capital reserve, it will move as capital reserve. If it was, let's suppose, debenture redemption reserve, that will move as debenture redemption reserve. Okay. Next, difference, if any, between amount recorded as share capital plus any additional consideration in the form of cash means difference between purchase consideration and amount of share capital of transferor. Who is the transferor? We are talking about acquiree. Shall be transferred to capital reserve and should be presented separately from capital reserve. So if we see any difference between purchase consideration and the share capital of the transferor, that will go to capital reserve. Goodwill should not arise in this case. And this capital reserve, which gets generated because of this difference, will be kept separate. Okay, it will have to be presented separately. We will not mix up this type of capital reserve. Okay, yeah. So these are the steps that we need to follow in respect of accounting of common control transactions. So now we should look into examples to understand about all of these steps one by one. Okay, yeah. So let us just go to examples now. So let me just pick up one example. So I understand there's some problem to see the board. So there's a concern from Rohit. Definitely, Rohit. Definitely, yeah. So it will be done. Don't worry about it. Let's move on to the illustrations, please. So let's pick up illustration number 30. This is page number 13.76. So page 13.76, illustration number 30. Yeah. So whenever you see any visibility problem on the board, please let us know, like Rohit just mentioned, and I'm just hoping this should be visible now. Let's pick up illustration number 30, please. Page number 13.76. Okay. Company X, the ultimate parent of large number of subsidiaries, reorganizes the retail segment of its business to consolidate all of its retail businesses in a single entity. Under the reorganization, company Z, so you can see this structure. You can see this structure on page number 13.77. Under the reorganization, company Z, a subsidiary and the biggest retail company in the group, acquires company X shareholding in its one operating subsidiary, company Y, by issuing its own shares to company X. Okay. After the transaction, company X will directly control the operating and financial policies of company Y. So you can see the structure, how the structure has changed after this reorganization. Yeah. Now in this case, you need to comment whether this is a business combination under common control or not. Quickly, over to you. Yes, quickly, over to you. You need to comment whether it's a business combination under common control or not. I think it's a fairly simple one. You can answer this easily. I'm waiting for a response. Tell me whether it's a business combination under common control or not. Quickly, I'm waiting for a response. Is it a common control transaction or not? Yeah. Is it a common control transaction? Yes or no? Let's go to the solution then. In this situation, Z pays consideration. Who is acquiring? Z. So who is the acquirer? Z. Who is the acquiree? Y. So Z is the acquirer, Y is the acquiring. Z pays consideration to X. Why X? Because X is the old shareholder. To obtain control of Y. The transaction therefore meets the definition of business combination. Why? Because control is coming to Z. We are assuming there is business. Prior to the reorganization, each of the parties were controlled by X. After the reorganization, although Y is now owned by Z, all these two companies are still ultimately owned and controlled by company X. From the perspective of company X, if we see, there's been no change. So if you look at the picture of the group, there's no change really as far as the ultimate parent is concerned. Therefore, this transaction would meet the criteria of common control business combination. Okay, clear on this? And I could see the responses from Chavi, Preeti, and Pujita. And they answered that yes, it's a business combination under common control. Great. So let's move on to the next one. Just 1 minute. Let me just pick this up. Yes, so we can move on to illustration number 32 now on page 13.78. ABC and XYZ are owned by 4 shareholders. B, C, D, and E, each of whom hold 25% shares in each company. So we have ABC and XYZ. Okay. They are owned by 4 shareholders, B, C, D, E. B, C, D, E. They own 25%. Correct. Similarly, they own 25% over here. This is how the shareholding is like. However, there are no agreements between any of the shareholders that they will exercise their voting power jointly. Okay. Whether ABC and XYZ are under common control. That's the query. That's the question. Tell me quickly. Can we say that ABC and XYZ in this case are under common control? Quickly. You understand common control? So we are not asking whether it's about common control business combination. So we are just asking in this question whether these two, ABC and XYZ, ABC and XYZ are under common control or not. That's it. Okay. Tell me. What should be the answer? Quickly, huh? Chavi is saying no, sir. It should not be a common control situation. But what others? Preeti is saying no because they are not going to exercise voting power jointly. So Preeti is also saying no. And I think Supriya has also joined us. Supriya, you would also like to answer this, please. Tell me quickly. Yes. Okay, so let's go to the solution then. Now, what is a common control business combination? So it's a business combination involving entities or businesses in which all the combining entities or businesses are ultimately controlled by the same party or parties, both before and after the business combination. Secondly, that control should not be transitory. So these are the two conditions. Further, if we go by Ind AS 103, it says an entity can be controlled by an individual or a group of individuals who may be acting together under a contractual arrangement, and that individual or group of individuals may not be subject to financial reporting requirements of Ind AS. Means it's not necessary that Ind AS should apply on these four. Yeah, it's not necessary that Ind AS should apply to all of them. Even if Ind AS doesn't apply to them, because let's suppose if these are individuals, then Ind AS will not apply to them. Correct? Yeah. Even if they are not subject to requirements of Ind AS. Therefore, it is not necessary for combining entities to be included as part of same consolidated financial statements for a control. Also, a group of individuals are regarded as controlling an entity when they collectively have the power to govern its financial and or operating policies. In the present case, there is no contractual arrangement between the shareholders to exercise control collectively. Okay. Therefore, these two companies, ABC and XYZ, are not considered to be under common control. Okay, clear? Yeah, let's move further. Now we can pick up. Illustration 33. Yes, so let's move on to the next illustration, number 33. (13.79) 33. ABC had a subsidiary. So you can see the structure, please. ABC had a subsidiary, namely X Limited, which was acquired on 1st April. ABC acquires all the shares of Y Limited. So after this, ABC is acquiring another company, Y Limited, on 1st of April 2x17. This is something which happens later on, after a few years. ABC transfers the shares in Y Limited to X Limited. ABC transfers the shares in Y Limited to X Limited on 2nd April to X17. Means the next day, shares which are there in Y Limited are transferred to X Limited. How should the above transfer of Y Limited into X Limited be accounted for in the consolidated financial statements of X Limited? Please remember that we are talking about consolidation requirement, or you can say the requirement related to business combination over here. Yeah, so we are not commenting about common control or not. So it's about accounting requirements. Quickly, can you answer this? So all the three structures are made available to you. So prior to the acquisition of Y, it was ABC and X. Then it became ABC, X and Y. And then it became ABC, then X, and below X it's Y. You can see this. Yes, quickly, if you can comment about the accounting requirement. Okay, I think Vanshika has a query around bargain purchase. Sure, Vanshika, we can go to that. Yeah. Let's discuss this, and after that we can discuss about bargain purchase once again. Yes, quickly. Over to this. What will be the accounting requirements? I think before we really get on to the accounting requirements, you have to think through around common control. So first of all, whether it's a common control or not. So because this is not really limited to common control, it goes beyond that. It talks about accounting requirements. So whether it's common control or not, and then what are the accounting requirements? Briefly, if you can just quickly let me know that answer, please. Yes, I'm waiting for a response. Tell me quickly, what will be the accounting requirements? So we discussed about accounting requirements, you remember? Can you just touch upon some of those accounting requirements? Or maybe whether it's a common control or not. I think that is apparent. Tell me quickly. So do we go to the solution then? Yeah. Okay. So now, once again, if we look at the requirements of Ind AS 103, in this case, if you see the structure, how this has been structured. So we have ABC, then we have X, and then we have Y. Correct? This is how it's been structured. Okay. And in this case, we understand that Y moved from this place to this place. Correct? This is how Y has moved. This is ABC. So Y was acquired, and within a day, Y was moved from this place to this place. Yeah, this is something which has happened. Okay, now we need to first of all check whether it's a common control or not. Now let's understand the requirements of Ind AS. Ind AS says that a company should move from one shareholder to another shareholder, but the ultimate controlling party, means this, should remain same before the acquisition and after the acquisition. That means for Y. So if we look at Y in this situation, before the acquisition by X and after the acquisition by X, Y is ultimately controlled by ABC. Secondly, it says that this control should not be transitory. Okay. The term transitory has been included as part of the guidance of Ind AS 103. Let's see what is this transitory. The word transitory has been included in the common control definition to ensure that acquisition accounting applies to those transactions that look as though they are combinations involving entities under common control, but which in fact represent genuine substantive business combinations with unrelated parties. Based on the above, if the intermediate step had been omitted, and instead X Limited had been ABC Group's vehicle for the acquisition of Y Limited, that is going straight to the after position, then X would have been identified as the acquirer. Considering X and Y are under common control, now they have the common parent. Y common control, they have the common parent, ABC. It might seem that acquisition accounting is not required because of the specific requirement of common control business combination. However, X Limited in this case should be identified as the acquirer and should account for its combination with Y Limited using acquisition accounting. This is because X Limited would have applied acquisition accounting for Y Limited if X had acquired Y Limited directly rather than through ABC Limited. Acquisition accounting cannot be avoided in the financial statements of X Limited simply by placing X Limited and Y Limited under common control, wherein ABC was having control over Y Limited for a very short period of time. Now, if you look at the financial year, on 1st of April, this transaction took place, and this transaction took place on 2nd April. Yeah. Now, what is transitory? Transitory means which should not really be done within a very short span of time. Now, if you just try to understand this transaction, in this transaction, few things have really changed very quickly, and that is about control of Y moving from ABC to X. Let's suppose Y was acquired by X directly. Currently, X is having control over Y. Let's suppose instead of routing Y through ABC, if Y was acquired directly by X, then what would have been the situation? We would not have considered this to be a business combination under common control. Yes or no? And why do we say that? Because in such a scenario, Y was not having the same parent earlier. It was coming from outside the group. If you see, Y did not belong to this group. Y was coming from outside the group. Is that true? Yes. So if a party is coming from outside the group, what do we call it as? Not a common control business combination. Means other than common control. And what type of accounting do we apply on that? Acquisition accounting. Acquisition accounting, you remember? Acquisition accounting is the accounting that we apply for other than common control business combination. Yeah. Now in this case, just by routing Y, which is a company from outside the group, through ABC, can we just avoid this accounting under acquisition, wherein PP, etc. will have to be done? The answer is no. Because this is transitory. Sorry, because this is transitory. That's why we should not consider this business combination to be the one under common control. This will not go under common control. This will be other than common control. And therefore, in this case, for X, what type of accounting will be required? Acquisition accounting will be required. Clear? All of you? Yeah? Any questions, any doubts in case you have on this, please let me know. And let me just see your responses also. Preeti, I think you must have understood. And Pujita, you must have understood. Yeah? Whether it's business combination under common control or not, and why not. But it's good that you have responded. Yeah. Okay, so then we can move on to another illustration wherein we will start getting onto the accounting requirements under common control. If you can see page number 13.81, if you can just go to the last sentence on page number 13.81, there is a test which has been shown. Test means the criteria which has been shown. It reads, acid test in assessing common control transaction is that before and after the reorganization, the entity which is getting restructured, for example, entity like Y, should be controlled by same shareholders. This is the acid test. Correct? Yeah, this is the acid test. Means this is the most important criteria. And to this, you should add that the control should not be transitory. Please add this, that the control should not be transitory. Please add to this. Okay? Yeah, please add to this. Control should not be transitory. All right, done. Very good. So then we can move on to next illustration on accounting requirements of business combination under common control. Page number 13.82, and we have this illustration number 34. How will the financial statements of the prior periods be restated under the common control in the following scenarios? So if you remember, we discussed about accounting requirements of common control, wherein some sort of restatement is required in the comparative period. Now we'll talk about that. We'll discuss about that restatement. How will that restatement be done? So we have first scenario, common control period extends beyond the start of comparative period. XYZ Limited acquired PQR in a common control. XYZ Limited acquired PQR in a common control on 1st of October 2000 X9. And this acquisition took place on 1st of October 2000 X9. The year end of XYZ is 31st March. And we'll go up to 31st March 2000 X, or we can just say 2X10. Something like this should be the year. Correct? Both XYZ and PQR have been controlled by shareholders since their incorporation. So we can assume that PQR was earlier controlled by same shareholder. Say this is N. N was having control over this as well as this. Let's suppose this is how they were controlled. Yeah. So that's why we will now say it's a common control business combination. Yeah. So this fact is established. It's a common control business combination. Now we are required to comment on the accounting requirements in this situation. So let's go to the solution. In accordance with Ind AS 103, entity will be required to restate its financial statements as if the financial statements are prepared as if the business combination had occurred from the beginning of the preceding period. Accordingly, in the present case, XYZ Limited, which is doing business combination accounting, will have to restate its comparatives for the financial year 2000 X8 X9. So let's suppose this is 2000 X9, 2000 2X10. Okay, let's suppose this is the reporting year, or you can say current year. So this is the year in which business combination took place under common control. And let's suppose this is the previous year, or we can say comparative year. And this is 2000 X8 X9. Yeah. Now, as per the requirements of standard, what do we assume? We will have XYZ Limited, which will do business combination accounting under common control, will have to restate its comparatives for the financial year X8 X9 also, as if acquisition had occurred before 1st April 2000 X8. So this is 1st of April 2000 X8. Additionally, the results of the current year of PQR, means the acquiree, will be required to include XYZ's financial statements for the period 1st April X9 to 30th September X9. Okay, yeah. Let's move on to the second situation. ABC Limited acquired DEF in a common control on 1st of October 2000 X9. So what I'm doing is I'm just placing the same situation. Now ABC acquired DEF. Say this is ABC, it acquired DEF. ABC acquired DEF in a common control transaction on the same date, 1st of October 2000 X9. Year end of ABC is 31st March. For ABC, once again, the year end is 31st March. Both ABC and DEF are controlled by one shareholder, A. So it was the same type of situation which we had, same dates. A made investment in ABC in 2000 X0. A made investment in ABC in 2000 X0, long time back, and made investment in DEF. So earlier DEF was here. Then it moved like this. Okay. And the investment in DEF was made on 1st of October 2000 X8. Means sometime during this financial year, this investment was made. I'm talking about these two. Clear? Yeah. So it's all about understanding the impact as to when this would start in respect of common control. Okay. Now let's understand what will ABC be required to do. Now once again the question that arises is that will ABC be required to restate, which XYZ did, and if yes, when should that restatement start? Okay, If you remember for XYZ, business combination accounting did not start from 1st of October. Yeah, it did not start from this date. When did it start? From this date. Why? Because it was assumed as if the business combination took place starting from this date. Now for ABC, we need to check whether the same sort of restatement will be required. Yeah, let's see. ABC will also have to restate its comparatives for the financial year X8, X9 as if the acquisition had occurred on 1st of October 2000 X8, but not earlier. Now, if we see when was this acquired within the group. So DF was acquired, basically it's a group. Basically it's a group. DF existed in the group for the first time on this date. 1st of October 2000 X8. Correct? Prior to this, it was not there in the group. So if it was not there in the group, when do we start its accounting in terms of restatement? From this date and not from first day of the preceding year. So that's the difference. Understood the difference in respect of accounting of XYZ as compared to ABC? Yeah. Additionally, if the results of current year, additionally, the results of current year of DEF will be required to include financial statements of ABC for the period from 1st of April 2000 X9 to 1st of October 2000 X9. Okay, which is the same thing. Clear? Any questions, any doubts in case you have on this, please let me know. Tell me, any questions, any doubts? No? So we can move on to next illustration then. Next one is again about the accounting requirements related to business combination under common control. So we can move on to that one as well. Yeah. Okay, so let's pick up illustration number 35 now. It is once again page number 13.82. We can start reading this illustration, please. A owns 100% equity shares of B since 1st April 2000 X1. This is 100%. A arranges loan funding from a financial institution in a new wholly owned subsidiary called C. So there is another wholly owned subsidiary C. The loan is used by C to acquire 100% shareholding in B for cash consideration of 2 lakhs. So what does it mean? That B is getting acquired by C. Entity A applies Ind AS 103 to account for common control transactions, and C will adopt the same policy. Fair value of net identifiable assets is 1,50,000 and the carrying value of net identifiable assets is 1 lakh. How will C? So now in this case, B is moving here. Correct? This is what we get to see. B is moving here. How will C apply acquisition accounting in its consolidated financial statements? So basically you need to only comment about the accounting requirement of C in this case. Do you want to attempt this, please? Yes, over to you. Do you want to attempt this? Do you want to answer this? Tell me what should be the accounting requirement for C. We are also given some numbers over here. It will be good for you to practice this. Though we have not practiced this at all ourselves, but if you can just attempt this first and then we can go to the solution, it will be great. Yes, quickly tell me about the accounting requirements. Yes, I'm waiting for a response. Tell me quickly what should be the accounting requirement in this case. So shall we go to the solution then? Yeah? Okay. Now in this case, once again, what do we see? That B is moving from A to C. Correct? And before acquisition and after acquisition by C, ultimate controlling party for B remains A. Okay? Yeah? Therefore, what do we say? It's a common control business combination. Based on this analysis, what do we say? C cannot be the acquirer. A has created C and is the seller. So C has effectively been formed and issued shares to affect the business combination. C is not a business, and the transaction between entity B and C is not a business combination. It is a reorganization of entity B. As a result, entity B's assets and liabilities are included in C's consolidated financial statements at their pre-combination carrying amounts without a fair value uplift. So if it's a common control business combination, what is the basis for picking up the assets and liabilities of B? Carrying amount. Now in this situation, C considered himself or itself to be an acquirer. Where do we use this definition of acquirer? In case of acquisition accounting, which is not the case over here. Can we apply acquisition accounting in this scenario? No. Why? Because it's a common control transaction. It's not a business combination other than common control. So that's why when C will pick up the assets and liabilities of B, those should be at carrying amount. Those cannot be at fair value. Clear? Yeah. You may be thinking, but sir, it's given in the question itself that it should be done at fair value. Acquisition accounting has to be applied. So that is what you will have to always understand. Preeti is asking, sir, is it transitory arrangement? No. See, till the time we are not made available information which proves it is transitory, we should not assume that. We should assume it otherwise. We should assume it's not transitory. And the same thing you can specify in the solution also. Pujita is saying it is under common control and will be accounted for at book value. Very good. Yeah. See, as I told you earlier, that there could be certain questions which may specify that this is how accounting needs to be done, and please help in solving that. Like, for example, which we see in this illustration. If you read the language of the question, let me just take you back. So it says, entity A applies 103 to common control and C will adopt the same policy. Fair value of net identifiable assets is 1,50,000 and carrying value is 1 lakh. How will entity C apply acquisition accounting? Now the question is saying, how will C apply acquisition accounting? Yeah, therein you need to tell that this acquisition accounting is not the one under not a common control, but the one under common control. Clear? All of you clear on this? Any questions, any doubts in case you have on this, please let me know. Quickly, if you have any questions, any doubts, because now what we will do is we will start with practicing various illustrations around business combination. So I would say we are done with business combination now in respect of various concepts which were involved, but it's very, very important to practice certain illustrations. So now as a next step, we'll move on to that. So before that, if you have any query, any doubt around anything that we have discussed so far, please let me know. I understand Vanshika had a query, so I'll come to that part. Okay, so Vanshika asked me a question about bargain purchase. So Vanshika asked me, so can you please explain goodwill or gain from a bargain purchase? Let's understand this once again. What is a bargain purchase? Bargain purchase is a situation when purchase consideration, let's suppose, is say 10,000 and fair value of net assets, let's suppose, is 17,000. Now in this case, do we get any goodwill? Yes. But the amount of goodwill is what? Negative. So goodwill is there, but it's negative. Correct? Yeah. This situation is called as bargain purchase situation. Or this situation is called as the situation wherein we get negative goodwill. Okay. In this situation, first point that we need to remember always is that instead of calling it as negative goodwill, we should call it as capital reserve. Okay. So this 7,000 will now become capital reserve. Number one. Number two, standard says that whenever you have bargain purchase, you need to reassure yourself that is this PP exercise, this is a PP exercise, correct? Is this PP exercise all right? You need to revisit this PPA completely. If you have revisited and you are sure that yes, it's a bargain purchase gain, then you need to account for this bargain purchase under OCI. So this will go to OCI, other comprehensive income. And from OCI, this will get collected to equity. Obviously, because where do we present OCI? Ultimately in equity. Let's suppose when you were reassuring yourself that whether this gain should arise or not, and you couldn't confirm, you were not very clear, you were not very sure, then the standard says you should not route it through OCI. Instead, you should take it to equity directly. That's the only thing that we have in case of bargain purchase. All right, Vanshika, clear? And all of you, I'm hoping that you would be clear on this bargain purchase. Yeah? Any more questions, any more doubts in case you have on this, please let me know. Now we can move on to one example before picking up some more illustrations from the study material. So I'm just taking you back to the business combination accounting and its comparison with acquisition accounting. Yes, so you can just see this example right now on your screen. Yeah, okay. So now, because we are done with business combination completely, so that's why we are picking up one example. I understand the font size is a bit slow, sorry, is a bit small. So that's why I'll also explain you all the numbers. Yeah, but I'm hoping that this is visible. I'm hoping this is visible. Entity P acquires 100% of V shares for rupees 1000, incurring transaction cost of rupees 200. V doesn't have any liability, only assets which V has got are two buildings, A and B, and their book values are given, sorry, those are not given separately. Their combined book value is rupees 700. Fair values of these two buildings are given separately, 300 and 600 respectively. Then we are also given the tax basis of these two buildings on a combined manner. 700 is the tax base of the buildings, and the income tax rate you need to assume is 20%. See, in this situation, once again, the idea is to just give you a comparative as to how business combination accounting will be different from asset acquisition. And whenever we will talk about business combination accounting, please remember that we will be talking about not a common control business combination. Unless it's specified, it will be considered to be not a common control business combination. You may be wondering, sir, why should this become a business combination? Because at one place we are saying V doesn't have any liability. It has got only two buildings. So are we sure that there's a business? No. We are assuming. We are just trying to check as to how the accounting will be done when it will be considered to be a business combination, and how will this accounting be different as compared to business combination when it will be considered to be an asset acquisition. Okay, clear? So if this is a business combination, first of all, we will compute the purchase consideration. It's 1,000. Purchase consideration, it's 1,000. Yeah. Next, any transaction cost which is incurred in case of business combination, what do we do with that? Take it to P&L, expense stock. Yeah. Do we have any purchase consideration in the form of deferred consideration, contingent consideration? Nothing. Do we have any previously held equity interest? Nothing. Do we have any NCI? No. So what is the total purchase consideration? 1,000. 1,000 is the total purchase consideration. Now from this, what do we need to reduce? Fair value of net assets acquired. Fair value of net assets is given 900. 900 is the fair value of net assets. Okay. And on this fair value of net assets, we also need to compute deferred tax, for which we will go to the requirements of Ind AS 12. Ind AS 103 does not explain you how to do this deferred tax computation. This is something you'll understand from Ind AS 12, which you may not be knowing right now. Have you covered deferred tax? Ind AS 12, have you covered? All of you, please confirm. Have you covered deferred tax? Yes or no? If you have not covered, again, don't worry. Just simply understand that deferred tax will be computed and it came out to be 40. It's a deferred tax liability. So what will be the total amount of assets? 900 minus 40. 900 minus 40. So what do we get? 860. 860 is the total amount of assets. This 860 needs to be reduced from 1,000. So what do we get? 140. 140, which is nothing but goodwill. 140 is what? Goodwill. Preeti is saying, yes, sir, deferred tax is covered. So I think you can also compute this deferred tax step. And you must be able to understand this in a better manner now. Yeah. Now, this is something which is about business combination accounting. And you may be thinking, but sir, we have already covered business combination accounting. This is so simple. Yes, it's true. Now let's try to understand how this accounting will be done if the business was not acquired. Let's suppose P acquires V and we will say that V doesn't have any business. So when such is the case, then the accounting will be done as per asset acquisition. If that is an asset acquisition, then what is the price paid? 1,000. 1,000 is paid, and for this transaction, some cost has been incurred. 200. So will that get capitalized with the cost of the asset? Yes. So 1,200 has been paid to acquire 2 buildings. P has paid 1,200 to acquire 2 buildings, A and B. Yeah. Now what do we do? This 1,200 will be allocated to buildings A and B in the ratio of their fair values. So what will be the value of building A? 400. What will be the value of building B? 800. Do we get any goodwill in this case? No, there's no goodwill in case of asset acquisition. Yeah. And which Ind AS we will apply in this case? In this case, we will apply Ind AS 16. In this case, which Ind AS we have applied? in this case, we would have applied Ind AS 103. Correct? Yeah, clear on this? Idea was once again to just give you a comparative as to how the business combination accounting can be different from asset acquisition. Okay, yeah, clear? Any questions, any doubts in case you have on this, please let me know. Though I'm getting very few queries from you, but still, if you have any query, any doubt, please let me know. No questions? So then we can move on to some more illustrations now. And idea today is to really practice the illustrations. Okay, so then we can move on to illustration number 36 on page number 13.87. And I think a couple of illustrations should be there for your homework also. I'm hoping that you are completing your homework, which I have been giving you for practice. So illustration number 31, I think you should take as homework. Illustration 31. Okay, and this is page number 13.77. Yeah, clear? Now we are beginning with illustration number 36, and please understand that all of these illustrations will have to be solved by you. Please don't wait for me to solve this illustration. Please start solving all of these illustrations on your own. Please understand that we are now done with business combinations, and that's why it's very, very important that you start practicing questions. So some of these questions which we are practicing in the class doesn't mean that you need to just follow me in terms of whatever I am writing, whatever I am solving. The solution is there in the study material also, and I will also solve this based on what is there in the study material. But it will be great if you can attempt this on your own. Yeah? Clear? Yeah? Okay. Enterprise Limited has two divisions, laptops and mobiles. They have two divisions, okay? Division laptops has been making constant profits, while the other division of mobiles has been suffering losses. On 31st March X2, division-wise draft extract of the balance sheet are given to us. So we have assets, liabilities, surplus. Division Mobiles, along with its assets and liabilities, was sold for rupees 25 crore to another company, Turnaround Limited, a new company who allotted 1 crore equity shares of rupees 10 each. So we can say the structure is something like this. E Limited. E I am saying for Enterprise Limited. It has two divisions. Laptops, mobiles. Laptop is into profits. This has been into losses. And now we see division mobile is getting sold to Turnaround Limited. So T Limited has come and acquired this division. This was sold for 25 crore to T Limited, who allotted. So the purchase consideration is in the form of equity shares at a premium of rupees 15 per share to the members of E Limited, in full settlement of the consideration in proportion to their shareholding in the company. One of the members of E Limited was holding 52% shareholding of the company, which is again fine. So one was holding 52% and there were many others. Assuming there are no other transactions, you are asked to pass journal entries in the books of E Limited. Who is E Limited? The entity which is selling one of its division, or one of its division is moving out. Prepare the balance sheet of E Limited after the entries passed for this sort of demerger. So it's a kind of demerger. Yeah. Prepare the balance sheet of T Limited. So these three are the requirements. So before we move on to this, a very, very simple question for all of you. In fact, I have a couple of questions for all of you. First, do we say there's a business combination? Number two, do we say it's a common control? Yes. It will be great if you can just start answering these two questions before you move on to solving this entire question yourself. As I told you, you should start solving this on your own. But before that, a couple of questions you need to answer, please. Tell me. Waiting for a response. Should this be a business combination or not? Whether it will be common control or not. Yes, all of you, please answer. You have not been answering today, except for a few, huh? Please answer this. It's very easy. So why you are taking so much time? Tell me quickly. Okay, Kostab has finally answered this. Kostab is saying, yes, sir, there's a business combination because there was a control and there was a business. Secondly, Kostab is saying, sir, it's not a common control transaction. So Kostab is saying this is yes and this is no. What about others? Any more responses from your side? Chavi is saying, yes, sir, it's a business combination. It's not a common control. Pujita is saying, sir, it is common control. Great. Pujita, can you tell me why do you think it should be a common control transaction? Preeti is saying, sir, it's not a common control transaction, but it is a business combination. Can you tell me why do you think it's common control? For common control, what's the first requirement? That before the acquisition, now what is getting acquired? This division by this company. Now this division before acquisition was controlled by whom? E Limited. After acquisition, it is controlled by whom? T Limited. Do we see a single shareholder over these two? No. These two are two different groups. Correct? So can it therefore become common control? No, it cannot be common control. Yeah. But yes, it's a business combination because it's a running business, which may be incurring losses. Correct? Yeah. Clear? Okay. So now, can you just start moving on to the solution, please? First of all, journal entries you need to prepare. Can you tell me the journal entries to be passed in the books of E Limited? Journal entries that will be passed in the books of E Limited. Can you let me know those journal entries, please? Quickly, it's very, very simple. So do we go to the solution then? Yeah. As I told you, even if I'm solving this, please make sure that you are also solving this yourself. And if by chance you get stuck on any point, you should follow me. Otherwise, you should solve this independently and share your answers with me. Yeah. So 2 balance sheets are required to be prepared. You can share the numbers which you are getting in the balance sheet of both E Limited and T Limited. Okay. First of all, let's think about the journal entries. And in the exam, you will have to be very, very presentable. So you'll say journal entries in the books of Enterprise Limited. I'm just writing E Limited, that is Enterprise Limited only. Yeah? You cannot do this in the exam. So that's why I'll also write the full form better. Enterprise Limited. Okay. And in terms of the year, we'll assume this transaction takes place at year end only, 31st March X2. Okay. So let's now understand the accounting entry. Now the assets of Mobile Limited are moving out. Liabilities of mobile division are moving out. So what are the liabilities of Mobile Limited? 300 are the loan funds, 100 is the reserve, negative reserve. Then we see PP is 100, current assets are 500, current liabilities are 400. Okay. And do we have their fair valuation available? No. Their fair values are not available. Anyways, it doesn't matter to us. Why? Because we are not passing the accounting entries in the books of acquirer. This is a company whose division is moving out. This is not the acquirer. Enterprise Limited is not the acquirer. So who will anyways record these assets and liabilities in its books at fair value? Acquirer, not Enterprise Limited. Enterprise Limited will have to just do away with all of these assets and liabilities. So it will say loan funds debited. Why? Because liabilities are moving out. 300. Current liabilities debited. 400. Why? Because current liabilities are moving out. Then we'll say 2 PPE. What was PPE? 100. So either we can show PPE as net amount 100 or we can just give the gross amount. So we can give gross amount 500. In such a case, provision for depreciation will also have to be debited, which was 400. This is nothing but accumulated depreciation. Okay. Then the current assets are also moving out. Two current assets. What's the value of current assets? 500. Yeah. And are we done in terms of settlement? So the assets amounting to 1000 have moved out and liabilities amounting to 1100 have moved out. Yes. So there's a difference. What's the difference? 100 is the difference. Now where do we take it? This will go to capital reserve. This will go to capital reserve. Yeah. Now what we can do is we can prepare the balance sheet of Enterprise Limited, and then we can prepare the balance sheet of Turnaround Limited. Okay. So there are a few notes in the question. I'll come to those notes also slightly later. First of all, let's prepare the balance sheets. And the balance sheet of Enterprise Limited is required to be prepared after passing these entries. So that means after the mobile division is gone out, then we prepare the balance sheet. And whenever we will prepare the balance sheet of a company, please remember, we will have to follow the requirements of Schedule 3. Always. Okay? Yeah? So we will prepare balance sheet Enterprise Limited after reconstruction. So now we'll need the layout, and in the layout of the balance sheet, we will also need notes to accounts. See, whenever balance sheet will be prepared as per Schedule 3 format, we will have to include notes to accounts. Notes to accounts means the schedules, okay, which used to be called as schedules for PPE, for current assets, for current liabilities, for reserve and surplus, for share capital. All of them are required. At times you may think these are unnecessary, but still those are important. Okay, depending on the information which is available in the question. In the current question, information is very limited and the numbers are direct. So that's why some of the notes may not be prepared. But whenever any working is involved, wherein the numbers are changing, it's very, very important to show notes to accounts. Okay, I'm not talking about the disclosures. I'm talking about notes to accounts, which are towards the numbers which will be presented on the face of the balance sheet, on the face of the P&L. Okay, clear on this? So now, here the balance sheet. What do we have? We have, now all of these items we can start with the balance sheet which is available in the question. So we have PPE still left because all the assets and liabilities of laptop division are left. So those will have to be accounted for. PPE is left, current assets, current liabilities are there. Then loan funds are gone because those were only in case of mobile division. Capital is there. Yeah. And additional item which will arise after this demerger will be capital reserve. Okay. So we can just write down this balance sheet. This is as at 31st March 2000 X2. So first we have non-current assets. PPE. Then we have current assets, which is in the form of other current assets. And then we give the note number and then the amount. Now, as I told you, that this note number should ideally come for each and every head. But in our situation, in our question, the numbers are direct. Those are straight. So that's why we are not creating notes for each and every head of the balance sheet. Okay. So if you go to the balance sheet, what will be the amount of PPE? It is 25. And other current assets stand at 200. So this is 25, other current assets stand at 200. Do we have any other asset? No, but still, we'll just leave this for the time being as blank. And then we get equity and liabilities, wherein we'll start with equity. Once again, for equity, we can either consider giving a note, or we can just put the numbers directly over here, because again, the information is very, very limited right now. So we have equity share capital, which is in the nature of equity shares only, with equity shares of rupees 10 each. Of rupees 10 each. And what's the amount of equity? 25. Okay. Then we have other equity. This is nothing but the surplus. So surplus is there in the balance sheet. Yeah. This is 75. Surplus is there in the balance sheet, equivalent to 75. Then we have capital reserve. This is 100. Now this capital reserve arises from that acquisition entry, or you can say demerger entry in our case. Then we have liabilities, which include current liabilities only. So we can just take the total of these three. Then we have liabilities. Under liabilities, we have other current liabilities only, amounting to 25. So this is 225, and I understand this also becomes 225. So this is total. This is also total. Yeah. Yeah. Clear? Now, as around the equity shares which have been issued by Turnaround Limited, You may be thinking, sir, where are those gone? We have not considered those equity shares of Turnaround Limited. Therein you need to remember, because again, this is a mistake which is made by some students in the exam. Those equity shares of Turnaround Limited did not come to Enterprise Limited. Those have been issued to members of Enterprise Limited, means the shareholders of Enterprise Limited, because shareholders have sold it. That's why it will not come to the company. Company is not selling it. Shareholders are selling it. So the consideration is received by shareholders from Turnaround Limited. That's why you don't see it over here. Clear on this? Yeah. Any question around this aspect that we have covered so far? Kostov was asking, sir, in respect of the difference which arose in part number 1, which we have taken to capital reserve, where should this balance go? Will it not go to P&L in the books of Enterprise Limited? I'll come to that. Okay, I'll come to that. For the time being, please consider it will go to capital reserve. Ambika is saying, sir, there could be bargain purchase gain here. Let's see. That is something we'll have to analyze from the perspective of Turnaround Limited. Because all this accounting that we have done so far is not for the acquirer. For acquirer, accounting is yet to be done. That is Turnaround Limited. So let's see for turnaround what will be the accounting requirement. Okay, yeah. So I'll just use this balance sheet format as it is with changes in the numbers, because most of these assets only have moved to Turnaround Limited, and this is not really after reconstruction now. Now coming to the question of cost of, first of all, in part number 1, the difference of assets and liabilities has been taken to capital reserve because in the solution, in the study material, it's been assumed that it's a transaction under common control. And you may be thinking, sir, how is this possible? Why we are considering this to be a transaction under common control? It's an assumption which has been made. Nowhere it is specified that both the entities are under common control. It is only assumed. Please understand, this is only assumed. It's an assumption which has been made to give you the solution of a common control transaction. You can also solve it calling this to be not a common control transaction. Clear? Secondly, now because it's been assumed to be a common control transaction, that's why when we will prepare the balance sheet of Turnaround Limited, we will have to carry the same assumption. Clear on this? So whenever there is a common control transaction, what do you remember? Goodwill cannot arise. Number 2, assets and liabilities should move at book values. In the question, for some reason, fair value of assets and liabilities is not made available at the time of its acquisition by Turnaround Limited. So that could be the reason why such assumption has been made. At the same time, you may be thinking, but sir, nowhere it is mentioned that Turnaround Limited and Enterprise Limited are under common control. That's why I'm saying it's an assumption which has been taken. Clear? Clear on this part? All of you? Yeah? Ambika has just joined. No problem, Ambika. So we are not missed out anything specific, because for Turnaround Limited, anyways, we are just starting with. So let's go to the accounting of Turnaround Limited. Now, Turnaround Limited will pick up all the assets and liabilities of mobile division at book values. Yes or no? Yeah. So PPE, go back to that journal entry, was moved out at 100 rupees net. Now, turnaround limited will record a net amount. Turnaround limited will not record gross and provision for depreciation. It will be net amount. So, it will be the amount of PPE 100 for turnaround. Please remember, these are the numbers of mobile division in a way, because we don't know any other number of turnaround limited. So we'll assume that turnaround limited only has numbers of mobile divisions. Then the current assets, which moved from mobile division, was 500. Again, book values. Then the liabilities, which moved out of mobile division, was loan fund 300 and current liabilities 400. So we can just place those numbers. Current liabilities were 400. Okay, these were the liabilities. And we don't have so many items over here, so we have to just look around this aspect also. Yeah. Loan funds have moved out. Loan fund means borrowings. So we'll have to include the borrowings over here. So we can say first is the equity. On equity, we'll just see as to what should be the amount. And we may also have other equity. And then we have liabilities. So liabilities will come somewhere over here, which will include financial liabilities. Borrowings are what? Financial liabilities, correct? Borrowings are financial liabilities. So what was the amount of borrowing? 300. And then we have 400. Okay. Next. For equity, and if there is any other equity in this case, we can give the note reference 1 and 2. Now, unfortunately, because we are giving the note reference, that's why I'll need some space. For the time being, I don't have the space, so you can just go to the working note of the study material, please. Now, as around the equity of Turnaround Limited, what is the information that we have? Turnaround Limited issued 1 crore equity shares of rupees 10 each at a premium of rupees 15 per share. So that will be the share capital of Turnaround. 1 crore equity shares of rupees 10 each. All the numbers are in crores. So numbers are in crores. So 1 crore equity shares into 10. So this will become 10 crore. Because in the share capital, what do we include? We include only the face value. And the shares have been issued at a premium of rupees 15 per share. So 15 crore will be what? Security premium. So in the note of other equity, we will have 2 items. One will be security premium, which will be what? 15 crore. Which will be what? 15 crore. Plus, we will also need to check about the difference of purchase consideration paid and the assets and liabilities acquired. Yeah, so that's why I'll need some space now. So what I can do is I can just clear this part. So these were non-current assets. I'm just moving the numbers slightly here, please, to get some space. Then these are current assets. Other current assets, and then we get the total. So this is working note number 1. Purchase consideration paid is what? Purchase consideration is 10 crore is the capital at face value plus 15 crore at premium. So the total purchase consideration is 25 crore. Yes, 25 crore is the total purchase consideration. Yeah. Against this, we need to check the amount of net assets. How do we get net assets? Assets acquired are what? 100 plus 500. 600 less liabilities which have been acquired. What is the amount of liabilities which have been acquired? 400, 700. So what is the amount of net assets? 100. Net assets acquired are 100. So 25 crore has been paid and net assets acquired are 100, which is negative. So that means net liabilities are acquired. So net what do we get? Capital reserve. In this case, what do we get? 125 as the net, and this will be termed as capital reserve. Yes or no? This will be termed as capital reserve because in case of common control, if you remember, we said goodwill is not possible. Difference between these two will go to which place? Capital reserve. So we have capital reserve in this case. Yeah, we have capital reserve in this case. So where do we take it? We take it to other equity. We will take it to other equity. So we have capital reserve of 125 negative. Correct? So net, what does it become? 110 negative. Okay. Yeah. I have not created any notes, so that's why I've removed note number 1 also. But for this, I'm giving you the reference of working note number 1. All right. So all in all, what do we get? 600 over here. 600 over here. Okay. Yeah. So this is how the balance sheet of acquirer will be prepared, but assuming it's a case of common control. All of you clear on this? Any questions, any doubts in case you have on this, please let me know. Then we can go in for a break. I'm sure that you will be looking for a break now and you will be thinking, so we have not taken a break. So we'll definitely go for a break now. But before the break, if you have any questions, any doubts, please let me know. Any questions, any doubts in case you have, please let me know. Tell me quickly, any questions, any doubts? Yes, I'm waiting for a response. No questions, no doubts, you're clear on this? Yeah, clear? With this, I'm hoping that you would have got more clarity around the accounting which is required to be done for common control. Yeah, clear? Okay, great. So then we can go in for break now. After the break, as we discussed, we'll continue practicing more illustrations based on business combinations. Okay. In the meantime, still, if you believe you have any query, you want to just think about it and come back with your queries, please post down your queries, and after the break, we'll have a discussion on your queries also. Okay. Yeah. So let's take a break of 10 minutes now. Hi, welcome back. So I have this query from Costa. Costa is asking, sir, in this case, surplus of rupees 100, which is appearing in the mobile division, will that be transferred to the equity shareholders after the demerger? Am I right? So if you remember, in the mobile division, there was no surplus. There were losses. And because the assets and liabilities have all moved, so that's why all those numbers have automatically moved to the new company, that is Turnaround Limited. Okay. Let's move on to the next illustration. We can pick up illustration number 39 on page number 13.101. You can start reading this illustration, please. Illustration 39. On 9th April 2000X2, Sham Limited, a listed company, started to negotiate with Ram Limited, which is an unlisted company, about the possibility of merger. On 10th of May 2000X2, Board of Directors of Sham Limited authorized their management to pursue the merger with Ram Limited. Then, on 15th May, management of Sham Limited offered management of Ram Limited 12,000 shares of Sham Limited against their total shareholding. So they want to acquire Ram Limited. Sham Limited wants to acquire Ram Limited. On 31st May 2000X2, Board of Directors of Ram Limited accepted the offer subject to shareholders' vote. On 2nd June 2000X2, both the companies jointly made a press release about the proposed merger. On 10th of June, shareholders of Ram Limited approved the terms of the merger. On 15th of June, shares were allotted to the shareholders of Ram Limited. Which shares? Shares of Sham Limited. Market price of the shares of Sham Limited were as follows, means on various dates. So we have multiple dates. Now it's a very, very simple question. I'm sure that you will be able to answer this very fast. We have multiple dates available. You remember, when multiple dates are available, what becomes the problem? Acquisition date. In this question, what will be the acquisition date, and therefore what will be the purchase consideration? Quickly, I think you can answer this very fast. Quickly, all of you, what will be the acquisition date? Yes, quickly, what will be the acquisition date and what will be the purchase consideration? Yes, tell me. Waiting for a response. It's a very, very simple one. Okay, great. Ambika has answered this. Ambika is saying, sir, 15th of June. 15th of June is the date of acquisition. And why do we consider 15th of June? Let's understand. See, till the time shareholders' approval is not obtained, can we say control can be passed on? Not at all. So, shareholders' approval is obtained on 10th of June. So, that means prior to that, any date is of no relevance. In this case, even though shareholders approved on 10th of June, still the shares were not allotted to Ram Limited shareholders. So that's why, when is the date of the acquisition which will be considered for the purposes of computation of purchase consideration, that will be 15th of June. Yeah. And on 15th of June, what is the price? 90. How many shares are being issued for purchase consideration? For purchase consideration, 12,000 shares are issued. 12,000 into 90. So what do we get? 10,80,000. Simple, easy to do. Yeah. And I think same is the response from Chavi, and Chavi also computed this purchase consideration. Very good. Costa also answered the same thing. I've just received these responses. Ambika also computed the purchase consideration. Pujita also shared the same answer. Very good. Okay, so then we can pick up another illustration. I think we can go to illustration number 38 now. Let's go to illustration number 38. Sorry, let's pick up 40. 13.102. Illustration is 40. Please start reading this and start solving this, all of you. See, it's all about practicing the questions. That's why it's very, very important you do this on your own. Balance sheet of P Limited and D Limited as at 31st March X2 are given below. Professional Limited and Dynamic Limited. Their PPE, investments, inventories, financial assets, equity. Then we have other equity, long-term borrowings, provisions, deferred tax. So it's a full-blown balance sheet, which they have. Then we have multiple information, various other information available. P Limited acquired D Limited 70% on 1st of April 2000 X2. So that means the date on which this balance sheet is available, very same day, Professional Limited acquired Dynamic Limited, but not 100%, 70%. By issuing its own shares in the ratio of 1 share of P Limited for every 2 shares of Dynamic Limited. So how's the purchase consideration paid? Through equity shares. Fair value of the shares of P was ₹40 per share on that date. Fair value exercise resulted in the following. Fair value exercise means now the fair valuation will have to be done. Fair value of PPE was 350 lakhs. And which fair value is this? It's about fair valuation of the acquiree. That means Dynamic Limited. P Limited also agreed to pay additional payment as consideration, that is higher of 35 lakhs and 25% of any excess profits in the first year after acquisition over its profits in the preceding 12 months made by Dynamic Limited. This additional amount will be due after 2 years. Dynamic Limited has earned 10 lakh profit in the preceding year and expects to earn another 20 lakhs. Now, what do we call it as? Contingent consideration. Yeah, you remember contingent consideration? It's a case of contingent consideration. In addition to above, P Limited also agreed to pay one of the founder shareholder a payment of ₹20 lakhs, provided he stays with the company for 2 years after the acquisition. So this is again what? Contingent consideration. Or you can also say it's a kind of deferred consideration. Dynamic Limited had certain equity settled share-based payment awards, original award, which got replaced by the new awards issued by Professional Limited. So they had certain share-based payment awards which are replaced by those issued by Professional Limited. As per the original term, the vesting period was 4 years. And as of the acquisition date, employees of Dynamic Limited have already served 2 years of service. So that means 2 years have been served. As per the replaced awards, the vesting period has been reduced to 1 year. See, total vesting period was 4 years. 2 years are already done. Remaining vesting period was 2 years. Out of this remaining vesting period, 1 year has been cut. The vesting period has been reduced to 1 year. That is 1 year from the date of acquisition. Now, for this purpose, you will need to have some understanding of share-based payments. That means Ind AS 102. So, can you tell me whether you have covered Ind AS 102 or not? All of you, quickly. Can you please let me know whether you have covered Ind AS 102? The fair value of the award on the date of acquisition was as follows. Original award fair value was rupees 5 lakh. Replacement award fair value was rupees 8 lakhs. Okay. Dynamic Limited had a lawsuit pending with a customer who had made a claim of rupees 50 lakhs. So what is this? Contingent liability. You may be thinking, sir, each and every ingredient is now included in this. Of course, yes. Management reliably estimated fair value of this liability to be rupees 5 lakhs. And once again, you may be thinking, but sir, claim was 50 lakhs. How can its fair value be 5 lakh? Because fair value is based on probabilities. On the basis of probabilities, fair values are computed. So that's why it can be lower than the claim amount. Applicable tax rate for both the companies is 30%. You are required to prepare opening consolidated balance sheet of P Limited after the acquisition. Assume 10% as the discount rate wherever required. Where will you require discount rate? Whenever any present value will have to be computed. Correct? So wherever you will need to compute present value, discount rate will be required. Yes or no? Yeah? Tell me quickly now. In this situation, what do you think? Should this be a case of common control or not a common control? So let's suppose if in the exam you get this question, can you take the assumption that it's a case of common control and start solving this, or you believe otherwise? Tell me quickly. Before we move on to the solution, it's important to understand about this from you. Okay, Pujita has confirmed that 102 has been covered by us. That's great. So that means you will not find any problem in solving this. Correct? Okay, very good. Now I'm waiting for a response on common control assumption. If you remember in illustration number 36, we took an assumption and solved that as a case of common control. Can the similar assumption be made for this type of question in the exam? What do you think? Yes or no? Will it be appropriate assumption if you take that? Ambika is saying no, sir. Common control is not possible. See, please remember, in the exam at times, you may get confused. Now, it's very, very important from examination perspective. At times, you may get confused and you may think of taking assumptions. but your assumption should be logical. You can't just say that because we have assumed, so we can solve it like this. Till the time your assumptions are not logical, those will not be accepted. Now, in this question, each and every information around fair valuation is available, which is required for acquisition accounting. Nowhere it is mentioned that substantiate or through which we get to understand it's a case of common control. So that means we should consider this to be a case of not a common control. When we consider this to be a case of acquisition accounting, therefore, what do we need? Fair valuation of assets, fair valuation of liabilities, every information about acquisition accounting, all such information is also available. Now, what is stopping us from applying acquisition accounting in this case? Nothing. Now, let's suppose even then we assume this to be a case of common control, saying that in the study material we also took an assumption when the information was missing. So will that be appropriate here? Let's understand. Let's go back to the question. If you look at other information, point number B, which again has various subpoints, all of these points will become useless if you use common control assumption. Yes or no? All these points will become useless, isn't it? So do you think that really is the intent of the question? Not at all. Not at all. So that's why, will it be the appropriate assumption of considering this to be a common control? Not at all. So clear on this, that in the exam, in such type of situations, you cannot assume this to be a common control. And why? Okay, clear? So let's go to the solution now. Now, you can start solving this, please. And while you solve this, please leave a space at the beginning for preparation of consolidated balance sheet. Unfortunately, because of this space constraint, I will not be starting with the consolidated balance sheet. So I'll be starting with the working notes. Okay. And if you have already started, you can just start sharing your inputs. You can just start sharing your final numbers also with me. Okay. Okay. So I'm just starting with the notes first of all. This will be a case of acquisition accounting. So as per Ind AS 103, acquirer is required to record assets and liabilities at their fair values. Okay. So PP of Dynamic Limited in this case will be recorded at 350 lakhs. Correct? Okay. Number 2. Value of replacement award. Coming to the next adjustment. Value of replacement award is allocated between consideration transfer and the post combination expense. Portion attributable to purchase consideration is determined based on fair value of replacement award for the services rendered till the date of acquisition. Accordingly, 5 into 2 divided by 4. Why 2 divided by 4? This is the part which is related to original award. If you go back to the question, we have original awards valuation as 5 lakhs. Correct? And replacement award valuation is 8 lakhs. Please go back to the question. Yeah. Now we are allocating it into 2 parts. So 5 lakhs, which has got vested up to 2 years, out of total vesting period of 4 years, is considered as part of purchase consideration. So this much amount will be a part of purchase consideration because this much service has been rendered, this much reserve, or you can say sort of expense is existing in the books of acquiring, and this will be credited to P Limited, because this will be settled by P Limited in its own equity. The balance 2.5 lakhs means out of 5 lakhs, 2.5 lakhs will be adjusted by this. Balance 2.5 lakhs will be recorded as employee expense in the books of Dynamic Limited over the remaining life. What is that remaining life? 1 year. Because now the vesting period has reduced from 4 to 3 years. Let's understand this. 2, 3, 4. So we had 5 lakhs as the total value. And this is when the vesting period gets over. Out of this period, 2 years are already over. So 2.5 lakhs pertains to this period. Where would this amount go? This would go to other equity. And this amount is yet to be expensed on. This is yet to be accrued in terms of expense. But now this period is cut on a go-forward basis. After this, it will be accounted for only up to 1 year. So 2.5 will be accounted for over next 1 year. Okay. Note number 3, note number C. So I'm just going through the notes only for your understanding. Then we'll get on to the computation also. There's a difference between contingent consideration and deferred consideration. In the given case, now which adjustment we need to pick up? Adjustment number B. So let's read this adjustment once again, and let me just put down all of these facts for the purposes of your understanding. So we need to understand all of these adjustments before we get on to the computation. And the first computation for business combination accounting, that means acquisition accounting, has to be PPA exercise. So for PPA, we are just setting our base completely. P Limited agreed to pay additional payment as consideration, that is higher of 35 lakhs or 25% of any excess profits in the first year. Excess means after acquisition over its profits in the preceding 12 months made by Dynamic Limited. Excess means over 12 months preceding period. Okay. This additional amount will be due after 2 years. And this additional amount or this additional amount will be due after 2 years. Dynamic Limited has earned 10 lakhs in the preceding year. So in the preceding year, it earned 10 lakhs. Okay. And expects to earn another 20 lakhs. So now it is expecting that this number in the current year should be 20 lakhs. So excess of 20 over 10 into 25% will be this number, or 35 lakhs, whichever is higher. Yeah. And in addition to this, so this is B, and then we have C. Then we have C. Then we have C. P Limited also agreed to pay one of the founder shareholder a payment of 20 lakhs. Payment of 20 lakhs. provided he stays with the company for 2 years after the acquisition, subject to some condition. Okay. Yeah. So this is the fact pattern. In the given case, now if you look at this situation, 35 is the minimum payment to be paid after 2 years. When was this payable? After 2 years. And accordingly, it will be considered as deferred consideration. The other element is if the company meets certain target, they will get 25% of that or 35, whichever is higher. In the given case, since the minimum which is expected to be paid, the fair value of the contingent consideration has been considered as 0. The impact of time value on deferred consideration has been given at the rate 10%. Now, for our purposes, we need to consider higher of these two, correct? And we need to consider the contingent consideration in terms of its fair value. Now, contingent consideration is what? This is contingent consideration. But what is the understanding? That either this or this, whichever is higher, will be paid. Now, this is contingent consideration. But for this contingent consideration, do we have any fair value available? No. So this has been considered to be 0, nil. So by default, its fair value or its present value will also become nil. Yes or no? Then we move on to this component. Additional consideration of 20 lakhs to be paid to the founder shareholder is contingent to him or her continuing in employment, and hence this will be considered as employee compensation and will be recorded as post combination expense in the income statement of Dynamic Limited. Obviously, because when he'll stay, then this much amount will have to be accounted for, correct? Yeah. So these are some of the things which we wanted to understand before moving on to the computation of purchase consideration. So now we can start with purchase consideration. Now, once again, what you should do is in the exam, you should first of all leave space for consolidated balance sheet, and then you should start with all of these notes and including the working computations. Okay. So I would say now working number 1 starts, that is about purchase consideration. After the purchase consideration, we'll also need PPA, correct? Now, in terms of purchase consideration, what do we have? Share capital of Dynamic Limited. What is that? 4 crore. Now, number of shares which P Limited will issue is in the ratio of 2:1. So let's understand the number of shares of P Limited. P Limited has got how many shares? Sorry, share capital of Dynamic Limited is what? 4 lakh. Yeah. P Limited will issue 1 share for every 2 held. P Limited will issue 1 share for every 2 held. Yeah. So how many shares P Limited will issue? P Limited will issue half of the share capital of Dynamic Limited. So number of shares of Dynamic Limited is what? 4 lakh. Shares to be issued. 2:1. Half of this will become 2 lakh. And these shares will be issued at the rate rupees 40 per share. Fair value per share rupees 40. Fair value per share will be rupees 40. Okay, yeah. Now, what is going to be the purchase consideration? 2 lakh shares into 40 into 70%. So what does it become? It becomes 56 lakhs. So this becomes 56 lakhs. Okay. Then we have deferred consideration. What is deferred consideration? 35 lakhs or the contingent consideration, whichever is higher, which is payable after 2 years. At the rate 35 lakhs payable after 2 years. So present value of 35 lakhs, that is over 2 years, using 10% as the discount rate. So you can compute this. So what do we need to do? We need to compute the present value. Simply, we need to compute the present value of 35 lakhs at the rate 10%, means using 10% as the discount rate over a period of 2 years. So what do we get? 28.93 lakhs. In fact, the numbers are given in lakhs, so I'll also put down the numbers in lakhs now. Okay, yeah, clear? So this is the deferred consideration. Third component was 20 lakhs to be paid if the founder shareholder stays with the company for another 2 years. As we discussed, that 20 lakhs which will be paid to the founder shareholder if he stays with the company for another 2 years, will not form part of purchase consideration. That will not form part of purchase consideration. Instead, that will be accounted for as employee compensation expense over the period of 2 years. So that will not come over here. Clear? Yeah. Next adjustment is on account of share-based payments. Let's understand what is that adjustment. Replacement award market-based measure of acquiry award. That means 5 lakhs into ratio of portion of vesting period completed. That means 2 years divided by greater of total vesting period, that is 3 years, or original vesting period of the acquiry award, that is 4. So out of this, which one is bigger, 3 or 4, will form part of purchase consideration. So let's understand. So I would say adjustment on account of share-based payment. Now what is this adjustment? So we have 5 lakh into 2. Divided by 4. Now what is this 4? 2 lakhs is what? 2 years is what? 2 years is the period of vesting which has been completed already. Yeah. Why are we dividing this by 4? Because we are considering the proportionate out of total vesting period. We are considering this as a proportionate of total vesting period because if you remember in the adjustment, we discussed that out of 5 lakh, proportionate expense of 2 years out of 4 years has already moved to other equity. That is how we record share-based payments. Proportionate expense has already moved to other equity. So whatever amount has moved to other equity, that will be paid by the acquirer as part of purchase consideration. Correct? Yeah. And the remaining amount, that means for other 2 years, will have to be accounted for as and when it arises, means it will be expensed off over the remaining period. Now in our case, that remaining period has got reduced to 1 year. So when will that come? That will come in the next year. So that's why for our purposes, what do we pick up? We'll pick up this one as the proportion. So this will become 2.5 lakhs. So all in all, what will be the amount? 87.43 lakhs. 87.43 lakhs will be the total amount. Okay, yeah. 87.43 lakhs will be the total amount. Clear on this? Yeah. Any questions if you have on this computation, please let me know. Then we'll move on to PPA. If you have any questions, any doubts on this computation, please let me know. So we are on to PPA only. On the PPA, we have computed the first part, purchase consideration. On the PPA, we have computed the first part, purchase consideration. Now we will compute goodwill or capital reserve. Tell me quickly. Tell me quickly. Tell me quickly. Any questions, any doubts in case you have on this? No? Yeah? So shall I move further? Okay, great. So please remember, purchase consideration is 87.43 lakhs. So I'm then moving further on this PPA. Okay. Now on PPA, we need to pick up the amount of assets and liabilities. Let me just go to the amount of assets and liabilities in respect of Dynamic Limited. So the total assets of Dynamic Limited are 1380 lakhs. These are the total assets of Dynamic Limited. From this, what do we reduce? From this we reduce long-term borrowings. From this we reduce provisions, and from this we reduce deferred tax. So we get 1075, and from this we reduce short-term borrowings and trade payables, less 450. So we get 625. Total assets are 1380. These are the book values. From this reduce all liabilities. What's the amount of all liabilities? 200 plus 70 plus 70 plus 35 plus what are the other liabilities? Plus 150, 300. $200 is long-term borrowing, 70 is long-term provision, 35 is deferred tax liability, 150 is short-term borrowing, 300 is trade payable. Okay. So can you give me the total of these numbers? This comes out to 755. So we get 625 lakhs. We get 625 lakhs. Yeah. Now, another thing that we need to consider is the adjustment of fair value in this case. We have considered all the assets and liabilities at their book values. Correct? We have considered all the liabilities and assets at their book values, but for PPE, fair value is available in the question. Yes or no? What is the fair value? 350 lakhs. And what is the book value? 500 lakhs. So that means valuation of PPE or net assets should go down. Less reduction in PPE due to fair valuation. That is what? 150. So what do we get? What do we get after this? So this is 475 lakhs. 475 lakhs. Correct? Other than that, if you look at the question, there was also a contingent liability, which is also required to be recorded at the time of acquisition, but in the book values, contingent liability, so no, contingent liability is not recorded. So we'll say reduction in net assets due to fair value of contingent liability, 470. So this 625 is what? Book value of net assets, and this 470 is what? Fair value of net assets. Correct? If you want, you can just directly compute the fair value of net assets. We have just shown a movement of how the numbers have moved from book value to fair value. Okay, clear on this part? Clear on this part? Now, what is our objective? Our objective is to achieve goodwill or capital reserve. How do we get that? How do we get that? Total purchase consideration less fair value of net assets. So total purchase consideration we have that. From that we will reduce fair value of net assets. But on this fair value of net assets, we also need to compute deferred tax. Deferred tax is not already computed. We will have to compute that. So we'll have to compute that. Yeah. So let's adjust deferred tax on this fair valuation adjustment. Now, fair valuation adjustment is what portion? 150 plus 5. 155. Deferred tax will not be computed on 625. Please understand. On 625, deferred tax is already computed. If you remember, deferred tax is already appearing over here. But in relation to this 150, in relation to this 5, deferred tax will arise. So we'll have to account for that deferred tax and include that for the purposes of PPE. Yes or no? Yeah. So what do? I'll just continue with this part. So I'll just move the numbers up. So I'll say fair value of net assets is 470. This is what we are starting with. And on this, we will adjust deferred tax on 155. On this 155 deferred tax at the rate 30%. So what do we get? We get 46.50. So this amount becomes 516.50. Okay, yeah. You remember deferred tax is required to be adjusted? Okay. So we have got 516.50 plus. Unfortunately, in this question, every adjustment is there. This question is not a case of 100% acquisition. There is also MCI. How do we compute goodwill or capital reserve? Purchase consideration plus previously held equity interest plus NCI less net assets. So this we have computed. This was not there. This is yet to be computed. This we have computed. So NCI is also required to be included over here. Yes or no? So let's include NCI over here. So what will be the amount of NCI? NCI is 30%. Now there are two options available for NCI. Either we compute fair value of NCI, that is not available in the question, so we cannot assume that. What is the other method available? Proportionate share of fair value of net assets. What is the fair value of net assets? 516.50. Fair value of net assets is what? This. So 516.50 into 30%. So what do we get? We get 154.95. So then what is the total? What is the total that we get? $516.5 plus okay, yeah. So what do we adjust? Let me just compute this one quickly. 516.5 after adjusting with 154.95 we get 361.55. Okay, yeah. Now, in our case, purchase consideration has been already computed. What is purchase consideration? 87.43 less this one 361.55 what do we get? 274.12. So this comes out to be negative and therefore this will become capital reserve. Now in this case, please understand there are two approaches to solve this. Either I pick up purchase consideration over here and then I include NCI over here from which I can reduce this. Please understand now. Either I pick up purchase consideration over here, then I include NCI over here, add them, from which I reduce total net assets. Instead of that, what I have done is I picked up net amount, net adjusted amount. It's one and the same thing because we are getting this number as negative. So that's why instead of goodwill, what do we call it? Capital reserve. Clear, all of you? Any questions in case you have on this, please let me know. Because this is all that we had to do in this illustration. I would say the remaining part of this illustration is your homework. Remaining part simply means you have to prepare the balance sheet. That's it, which is very, very easy. We will also prepare that in the next session, but it's very important that you prepare that on your own. Try to attempt that. Okay, yeah. But before that, if you have any questions, any doubts around all of these adjustments that we have done, please let me know. This is nothing but PPA. In this PPA, there are multiple adjustments. And because of those adjustments, we cannot just put that down in a single working sheet. So we may require multiple working sheets, which is visible over here. Any questions, any doubts if you have on this? Kaustubh is asking, sir, can we present PPA in the exam as per your presentation? Or do we have to separately list out each and every asset or liability? No. See, in the exam, you can present it the way I have also shown you. It's not necessary that you will give the list of each and every asset like it's given in the study material. It's one and the same thing. So what I've tried to do is I've tried to pick up a shortcut. In the study material, each and every asset has been given just to explain you that where does this fair valuation arise from and how will that fair valuation be required to be adjusted somewhere over here. Okay, idea was really to make you understand, because some of the students will be only studying study material. So if they study material, they should be able to understand that. That's the objective. That doesn't mean you have to put down each and every asset. Not required. Okay, but in the exam you'll have to write total assets. But in relation to liabilities, you should list down the total liabilities. Otherwise, it may become very confusing for the examiner to understand how do you pick the total of liabilities. Okay. Any more questions? Any more doubts in case you have? Tell me. Please remember the homework, and I've given you another illustration for homework. No questions, no doubts. I'm hoping you have been able to understand the concept now and also solve the questions now, because it's all about business combinations that we had, and we have also tried to practice questions. But it's very, very important that you also practice the remaining questions of the study material. Yeah, there are many other illustrations which are available. Even though I have not separately, given that as a homework, you should consider practicing them. That will be helpful for you in terms of getting a better grasp of the concept. All right? Yeah. Okay, Preeti is saying, so the adjustment of deferred tax is not understood. See, Preeti, it's very simple. What is deferred tax? Deferred tax arises on temporary difference. Now, if you look at the question, value of assets and liabilities is divided into two parts. One, that is book value, and second is fair value. On the book value portion, deferred tax is already computed. How do we know that? It's given in the balance sheet. Okay. But on the fair value portion, deferred tax is not computed. Why? Because we have recognized that now. That fair valuation portion is recognized now. So on that fair valuation portion, we need to recognize deferred tax. On that fair valuation portion. And what is the rate at which we'll recognize the deferred tax? 30% it's available in the question. Clear? Understood? Now a question will arise, sir, what will be the tax base? Tax base of the fair value will be 0. Because taxation department will not accept the fair valuation. They will say it's 0 for me. Fair valuation is only for India's accounting purposes. So what is the tax base? 0. What is the book base? Fair value. Difference of these two will be temporary difference on which you apply 30%. Clear on this? Yeah. Preeti, I'm hoping you have understood this now. Any more questions? Any more doubts? Preeti, you have understood? So once you confirm, we can just wind up this session then. Yeah? It's clear now? Okay, got it. Very good. So with this, we can just end our discussion for today. In the next session, we will continue with this solution. Only if all of you say, if you will be done, then we'll just move on to consolidated financial statements in the next session. So we are all done with business combinations. Now we'll start with various aspects of consolidation. Okay, thanks so much.